Hello guys, what's good? Back at you with another video. This one is just going to be a small rundown on an undervalued stock at the minute. I've already done a previous video on it, but not in as much detail. It's going to be Bristol Myers Squibb. An opportunity in the market, I believe, at the minute. I think it's undervalued for compared to its fair value. I think it's got great fundamentals, and I genuinely think this could be something that could suit an income portfolio, a trader's portfolio, or someone who just buys and holds stocks. So, without further ado, let's just get straight into it. We've got the first thing I want to point out is the balance sheet. Before we go into the P ratios, dividends, all the market cap, that type of stuff, something that really catches my eye with Bristol Myers Squibb, right? We know they've just made an acquisition and took on some debt. We know that, but it's good debt. It's helping the company grow, and the acquisition has actually been paying off for them. So, before we get into that, right, this is a company that's backed by Warren Buffett. He's got around about, I think it's $2.5 billion stake in it, and that's just before we get off the bat. What we're looking for in a balance sheet, you're looking for cash equivalents and inventory levels, right? If inventory levels are spiking, so they're going up, it shows a weakened demand. And if cash and cash equivalents are going down, it shows a weakened financial position. So they're the two main things you want to look at just to take out all the mist of everything that's in it. What you want to look for is an increase in cash on the sidelines over time, which they can use to progress. And you also want to look at inventory levels, because the more they're getting rid of, the more money they're making, the more demand, the higher they can raise the prices, which leads to better margins. So here, Bristol Myers Squibb from 2016 December, as reported, they've gone from a 4 billion cash equivalent position, yeah, to a 10 billion in the last report. Like that, the last report will be due to some investing, obviously, in the pipeline. But as of December 2020, they're roughly four times the cash on the sideline. So it's a company that's becoming very financially strong. It's got good fundamentals for a start, and then you want to look, completely skip all this receivables. It's not something you need to get too bogged down with. And then we go to the inventory levels, right? The inventory levels, well, that's kind of irrelevant the first 3 years, but since 2019 into present, we can see the inventory level has halved, right? That's with an acquisition as well. So if the inventory level's half, there's obviously demand there for Bristol Myers products, and that's probably because of the Opdivo blockbuster drug they have, which is competing with Merck's Keytruda. Anyway, into the dividend, right? The dividend is just perfect, really. Nearly 15 years of dividend growth, or 14 to be specific. You've got a compound annual growth rate here of 4.62. The 15-year dividend growth there. Very low payout ratio, so the other 75% of the funds can go towards the company and growing and paying down some debt, which is good. And it's a nice, juicy 3% yield. So it'll take, if you buy and hold this stock and reinvest your dividends, nice yield, nice price, and you'll take advantage of the compound interest as we go along. So just after that, we've got the actual whole overlook of this company, right? The stock has been flat. As we can see here, we've traded roughly sideways. As you can see, 2% up in the last 12 months. It's been yo-yoing. It's getting to the higher end of that kind of bouncing range now, so we could be due for a breakout, but it's kind of traded around that 60 mark and got as high as, 66 come January, end of January time. But it's been bouncing within that range, so it's just brilliant to be able to accumulate some good shares and just be patient and wait for, around the 60 level. But this is the thing, right? You've got the forward PE on this stock is 8.7, which is 40% under its 5-year average on a non-GAAP basis, which basically means is that it's 40% undervalued compared to what the market has historically valued it at. It doesn't have a current PE because obviously it's just made the acquisition, so it's wiped out the EPS for the last year, which has then frightened off investors because it had then shown it's not got earnings. Well, we know it has. So Always look on a forward PE basis, and it'll kind of give you an estimate of where the company's heading rather than it'll take the short term, you know, ruffles out, and it'll give you a nice clear perspective of where you want to be. So as you can see here, 8 points ticking on 8.7 PE. There's the yield again, and the market cap is around about 144 billion. But if I just show you just something that I just need to touch on, is it's just the growth of this company. Where are you going to find when it decides to load? When are you going to find a company such as Bristol Myers, strong pipeline, which is growing at when it decides to load up here? 38%. 38% it grew by last year. So the acquisition's paying off. And if the drugs that are coming through the pipeline continue to press on, I believe myself that this company could grow quite rapidly into the future. You've got Opdivo, which is like a cancer drug. And I just don't understand where the market's kind of going from. We've got a strengthened cash position. You've got revenue growth, good dividend yield. The compound annual growth rate outpaces inflation at 4.6%. You've got good yield, good dividend growth record. And something that people don't really touch on with healthcare stocks is they're actually less correlated to inflation than gold is. Meaning, if you actually Google it over the century just past, healthcare stocks have outperformed gold during inflationary periods. So with everything that's going on in the market at the minute, I believe, Bristol Myers could be the one that is an inflation hedge, possibly, because healthcare is always going to be there. There's always going to be a demand for it, and we can't just stop buying healthcare because the prices have gone up. We need to still look after ourselves, and the government may stop the pricing power, but that's another story. There's a few things I don't like about Bristol Myers. The debt load that they've took on from the acquisition could weigh down on the balance sheet. I think it's around about 44 billion, but the revenues, kind of counteracts that, so it's not a massive problem. But the one thing that I really don't like with drug companies is you're focused on the pipeline. If this company screws up on some of its blockbuster drugs coming through the pipeline, or there's a delay by the FDA on approving these medicines, then you might see a slowdown in growth in Bristol Myers. However, I believe at this current price of 65.46, you're buying in at a good margin of safety. So the downside risk is a lot less than the upside. If this company continues to grow year over year, in the 20% range, it's perfect. And I believe with the profitability of it as well, which it's actually got one of the best margins out of its peers. So you've got I usually focus on the three healthcare stocks, which will be AbbVie, Merck, and Bristol Myers. I think it's got the best. Let's have a look now when what did it decide to load running. So look at that. It's nearly 50% higher on the margins, closer to its peers. So it's actually got pricing power. That further will show you that it's got that resilience in inflation. It can afford to up its prices. It's got the pricing power, so it's obviously got efficient manufacturing to have that sort of margin. So if inflation's going to bring down that margin, it's not going to bring it down by a lot. And in my guess would be Bristol Myers will obviously heighten the price to match the inflationary period that we possibly might go through. So just as a summary, we've got good fundamentals, good yield, good growth prospects at a good price. And the one thing you've got to kind of look out for and look into yourself is the patent cliffs that may come in the years to come, and their actual drug pipeline. So this has been just my little rundown really quickly on Bristol Myers. It's been flat this year, like I said, but I think it's something that you should be looking at, and I think it's something that, as we can see, Warren Buffett's invested in, and I think we should kind of just take a step back, drown out the noise of Wall Street on a dodgy quarterly report, because short-term pessimism as well is in this stock, and I think it deserves to be well above 65, where it's trading at now. Possibly my fair value target is around $90 to this stock. So roughly, I reckon 40 to 50% upside in the years to come. And I believe this company's set up for a very, very strong 2021, 2022, 2023 in the next 3 years. So that's just my take on it. If you've got any stocks that you're looking at, just drop them down below. Leave me a comment, like, subscribe, all that good stuff. Thanks for taking the time to watch this, and I'll catch you in the next one.